Hi, this is Andy Newman. I'm a real estate agent with 23 years experience. I'm in Richmond, Virginia, and today I want to talk to you about some income tax concerns that I have regarding Obamacare and the 3.8% tax. This 3.8% additional tax is part of the President's Patient Protection and Affordable Care Act, also known as Obamacare, and it affects people Congress has decided are wealthy. That is, single taxpayers with modified adjusted gross income, or MAGI, of $200,000 or more, $250,000 if they're married. If you fall into one of these categories, you'll pay 3.8% more in federal income tax on the lesser of your investment income or your excess MAGI, that is the amount that exceeds the $200,000 or $250,000 threshold, depending on whether you're single or married. Congress has introduced a third dimension, the Surtax, that'll affect every investment decision and transaction you make as long as the law stays in effect. If you have 2 or 3 kids, $250,000 is a relatively modest income in areas of the country where the cost of living is especially high. Nonetheless, couples with 2 working spouses are vulnerable to the surtax. But if they weren't married, I want you to know that their household income could be $400,000 before the surtax kicked in. But retirees could be surprised to find that they're victims of the surtax. Here's the problem. If they decide to sell the home that they've lived in for 35 years when they retire, thanks to the surtax, they could lose some of the profit that they make because it's considered a capital gain, that is, investment income. Gets a little hairy here, so hang on. Although income received from a pension, a traditional IRA, or company-sponsored retirement plan is not subject to the additional tax, it can push your other income above the threshold, exposing it to the surtax. So here's the 10 biggest things I think you need to know about this tax. When you add up all your income from every possible source and the total is less than $200,000, if you're married, $250,000, you'll not be subject to this tax. The 3.8% tax will never be collected as a transfer tax on real estate of any type, so you'll never pay this tax at the time you buy a home or other investment property. You'll never pay this tax at settlement when you sell your home or investment property. Any capital gain you realize at settlement is just one component of that year's gross income. If you sell your principal residence, you'll still receive the full benefit of the $250,000 exclusion, $500,000 if you're married filing jointly, on the sale of that home. So that's good. If your capital gain is bigger than these amounts, then you have to include any gain above these amounts as income on your Form 1040 tax return. Hang on, it gets a little hairy. Even then, if your total income is less than the $200,000 or $250,000 amounts, you'll not pay this tax. If your total income is more than these amounts, there's a formula that'll protect some portion of your investment. So that's good. Make sure you talk to a CPA, right? The tax applies to other types of investment income, not just real estate. If your income is more than the $200,000 or $250,000 amount, then the tax formula will be applied to capital gains, interest income, dividend income, and net rents. That is, the rents you receive after expenses are deducted. The tax goes into effect in 2013. If you have investment income in 2013, you won't pay the 3.8% tax until you file your 2013 Form 1040 tax return in 2014. And then the surtax for any later years will be paid the following calendar year when the tax returns are filed. So in any particular year, if you have no income from capital gains, rents, interest, or dividends, you'll never pay this tax even if you have millions of dollars of other types of income. So that's a good thing. The formula that determines the amount of 3.8% tax due will always protect $200,000, $250,000 if you're filing jointly, from any burden of the 3.8% tax. Like if you're single and you have a total of $201,000 income, the 3.8% tax will never be imposed on more than that extra $1,000. It's true that investment income from rents on an investment property could be subject to the 3.8% tax, but the only rental income that would be included in your gross income and therefore possibly subject to the tax is net rental income. Gross rents minus expenses like depreciation, interest, property tax, maintenance, and utilities. The tax was enacted along with the health care legislation back in 2010. It was added to the package just hours before the final vote and really without peer review. There were strong opponents to the tax at the time, and many are hopeful that it will not go into effect. So these are the ramifications as I understand them at this time. Of course, everything is subject to change. For sure, if you think next year's income will potentially be high enough to subject you to the surtax, you need to start adjusting your portfolio and income sources today. This is especially true for trusts. It's critical for you to find a tax expert who really understands this topic and to get their advice, as well as other professionals used to give such advice. I'm not an attorney, a CPA, or a financial advisor. I'm a real estate agent who's doing his best to explain, as I understand it, a tax that probably few of you out there knew was coming. Again, I'm Andy Newman. I appreciate your spending the time with me today. I hope it's been of help. If you'd like to contact me about helping you with your real estate needs in Virginia, here's how to do just that. Thanks again.